This is Keith Borglum, medical practice appraiser and broker at medicalpracticeappraisal.com. This presentation is about how professional appraisers appraise a medical practice. There's lots of reasons why to value a medical practice. Very commonly, it's for purchase or sale. It could be for associate buy-in. Oftentimes, it's for a divorce, or a professional divorce where a practice breaks up and different owners are going to take the pieces, or payout for an owner with or without a new owner coming in. Sometimes we need appraisals for insurance purposes, and sometimes for other litigation, non-compete agreements, and economic damages. People often confuse the issues of financial versus emotional value. Most owners feel a lot of pride of ownership in their practice that they've put in many years of blood, sweat, and tears. But when you go to the market and want cash for your practice, we have to take a look at what the market thinks it's worth on a fiscal basis. People often confuse the issues of value versus price. Value is an opinion by an appraiser or anyone based on a series of assumptions, often with facts, but sometimes not. Price, though, is the result of negotiation between two individuals, each with a unique interest. Many practices sell for a price above or below the appraised value. So, for example, a distressed seller may sell a practice for below the appraised value. A particular buyer with a strong need to be in a particular location might be willing to pay above the appraised value because there's a personal benefit to them that's different from your typical hypothetical buyer out there. Oftentimes, appraisal can have value without a sales price. For example, in a divorce, the physician is not selling the practice, but there has to be an allocation of the value for distribution purposes. There's a number of standards of value, of which fair market value is the most common. That's a hypothetical buyer, a hypothetical seller, both in possession of all the facts and neither under any undue adverse influence to act. It's very important that all of those factors are be considered for a fair market value, fair to the buyer, fair to the seller. Separately, there's investment value. So, for example, if a large chain of practices badly wants one in your area and you're the only option, to that particular buyer, there may be a value above the fair market value to them because they're going to bring additional value to the practice. For example, in a dermatology practice, you may have an organization that's going to be bringing Mohs surgery to the practice and lab testing to the practice. Fair value, there's no buyer involved. That's often what we use when we're looking at shareholder dissolutions. And liquidation value is the standard that we use. You can think about it like at auction, where there's going to be a cost of sale or a cost of liquidation. Now, when we look at a practice, we can look at the premise of going concern or the premise of liquidation. Premise of going concern is what's most often used in fair market value when we're looking at a practice that will continue after the exit of the current owner. There's different parts or components of value. It's pretty easy to value the tangible assets, the used value of the furniture, instruments, supplies. When we do accounts receivable, though, we have to discount not only for the collection ratio, because you never get paid what you charge unless you're in a cash practice, and the aging, wherein the accounts as they get older become harder to collect. So it's more complex than just applying your collection ratio to the accounts receivable, in which case you would be overvaluing them. It's the intangible value that becomes very difficult and is most contentious to value, what's often called goodwill or the value of blood, sweat, and tears. It really takes an expert appraiser to do that. When we have the tangible and intangible value, we then either subtract the liabilities from the value or the buyer may be assuming them, which can also have impact, or the seller can sell them. We have three approaches to value: the asset approach, the income approach, and the market comparison approach. In that asset approach, we look at the assembled components and then adjust it. It could be accumulation value. Adjusted book value takes the depreciation applied to those assets and adjust back to fair market value. When we look at the income approach, that's the most common approach. What's the value of that income stream to the owner? What's the return on investment that that buyer is going to get? And in the market approach, we try to find similar practices that have sold and compare this current practice to those. We rarely use the asset approach for small to medium-sized practices unless there's no dividends found by the income approach. Often, very small practices sell for assets, so there's no goodwill value, so they don't show up in the goodwill registry. We rarely use asset approach for less than a 50% ownership, because if you don't have a majority control, you don't have control over the dispersion of those assets. So we have to do some special adjustments to that and don't usually use it. There are circumstances where we do, but that's beyond the scope of this presentation. It's rarely used in limited asset business. So, for example, your primary care practices, your subspecialties of internal medicine tend not to have big equipment like a hospital or a large radiology group. So most practices, we're looking at the value of the income stream, not the value of the assets. If we have a very young practice, let's say a practice is a month old, and there aren't any income or income streams yet, we can use the asset approach to value that. Now, the income approach is most important. It's the favored ruling by the IRS in Revenue Ruling 5960 that says it must prevail absent good argument otherwise. The concept of that is that if there's no return on investment, there's no value. And if there is a return on investment, how do we calculate that? It's what we usually use for practices that are running, not a practice that's been closed by different circumstances. It's what we call the dividend-paying capacity, which is the individual's profit above labor that's commonly used. So, for example, as a family physician, lots of jobs out there at $200,000 a year. If you're earning less than $200,000 a year, that's less than comparable employment, so there's no return on investment to buy it. If a similar practice is earning $300,000 a year, let's say by leveraging ancillary services at mid-levels, there's $100,000 a year there above what the owner earns for their personal labor, which is what we use in calculating dividends. It's pretty clear that an extra $100,000 a year above what you can earn in a job has some value. Appraisal is what we do to calculate that value. When we look at the market approach, we try to compare that subject to other sales that have occurred. But we have to adjust it for time, place, and facts. How long ago did that other sale occur? Where was it? Urban, rural, north, south? What were other facts related to that practice sale? In the market approach, usually the seller is going to pay off any debts with the proceeds of sale. Usually they're going to collect their own accounts receivable or have them collected on their behalf, and usually they keep the cash, so we usually exclude those when we look at the market approach. So when we go back to compare, we have to, apples to apples, we have to look back and make sure that that occurred in our comparables. Goodwill is the most contentious asset to be valued. And people try to value goodwill and then add it to the value of the assets, which is rarely appropriate. Usually we go the other way around. We take the total value, or in the case of a sale, the total price. We subtract the value of the tangible assets, and that leaves the value of the intangible assets. Now, intangible assets may contain more than goodwill, for example, covenants not to compete, but for the discussion of this, we're going to use the terms as interchangeable, as does the Goodwill Registry. That is the biggest database for tracking goodwill, determining goodwill. We can do goodwill by report, we can do it by calculation. And there's different ways to go about that. When we look at that market comparison approach, when we look at those comparables, we have to look at similar purpose. Was it an actual sale? Was it an actual buy-in? Or was it a divorce ruling that wasn't actually a sale? Normally we exclude divorce rulings because that was up to the judge. And often the judge just cuts the baby in half and comes up with something to get the case off his desk. And it's not necessarily a good fair market value opinion. Size of practice can have a big difference. The really good large practices tend to have a higher ratio of value than do small practices. There's organizations out there that do what we call roll-ups. They'll buy 10 or 20 or 30 small practices and now have a big chain which they can then flip to an even bigger company and make a profit on the margin there. We have to look with the market comparison approaches, what method of valuation did they use in that prior transaction? Did they use a correct method? It can be very hard to tell because we don't know what they did. Usually all we have is perhaps a revenue stream and a sales price to look at. We don't even know how many hours the seller worked. If the seller worked 100 hours a week to earn 2.5 times the normal income, we don't know that. And maybe even the appraiser didn't know it if they didn't really dig into the details or understand the field. If a practice has a high overhead, a practice with two practices both earning $1 million, one with a 75% overhead and another with a 25% overhead, are clearly and logically going to have different values. And often in the market approach, we don't have that, whereas in the income approach we do. And the data transaction is very important. There's still databases being used out there that include sales that were before the first Medicare reimbursement cuts in 2004. And most of the databases include information from before the Accountable Care Act, what people call ObamaCare, which was finally resolved in October 2012. So those factors need to be considered to judge apples to apples using the market comparison approach. Even some states had short-term inflated values, like Florida, where there was a bidding up by entrepreneurs that was later shut down by the OIG for violation of Stark and things like that. And you have to try to find those and throw them out. When we're looking at tangible assets, usually we're looking at fair market value, which is a hypothetical buyer, hypothetical seller, both in possession of all the facts and neither under any adverse influence to act. Under a premise of going concern, meaning we're not liquidating it, it's an operating practice. When we consider the used value assembled in place, it's not liquidated auction value. When we liquidate at auction, usually you have to pay the auctioneer, and it depends on how many people are in the crowd. Much different crowd on eBay than there is on a particular site in a rural location. Tangible assets we don't value by depreciated value, what results in book value. For example, if you buy a $100,000 laser on December 31st, you depreciate it, and under accelerated depreciation, that laser could have a book value the next day on January 1st of 0, even though that laser is still in the box and still returnable. It's not logical that the fair market value would be 0 the next day, as you would find in a depreciated value. Depreciation schedules can be very helpful, though, to determine the asset price, the purchase price, the model that was purchased, the year of purchase of that particular item. Normally, as we said, in a tangible asset transaction, we exclude accounts receivable, cash equivalents like deposits on the office lease, and we assume that the seller is going to pay off liabilities at time of sale. Now, under the income approach, which is most favored, it values the income stream above market compensation of the owner that we talked about, what we call dividends. The income approach doesn't differentiate between your tangible assets and your goodwill. Just like buying a stock on the stock market in IBM, you don't really care about uh, how many computers and desks IBM has. You care about the return on investment. What's the value of the stock? What's the dividend that's paid? The issue is that it requires an opinion of the specialty future growth rate, not the historic practice growth rate. A particular practice may or may not be running at the long-term growth rate. Uh, we're unable to tell, but as appraisers, we have databases to determine the overviews of these growth rates, the economic growth rate of the industry and the economy, rather than a practice. So a brand new practice could double the first month, double again the second month, double again the third month, but that's not a long-term growth rate. It also requires an opinion of market rate, risk, and return. This is where I find most errors are made. Medical practices are much riskier than buying stocks on the stock market. They're riskier than other licensed professions that don't have medical malpractice liability and government intervention and HMOs and things like that. So you need a higher return on investment to create that higher value. To calculate what is the appropriate return on investment, we often use what's called the build-up approach. So we start with the lowest risk investment, which typically is 20-year Treasury bonds. If you want to take more risk, you might put your money over in the stock market, for example, the S&P 500. Then we look at what about the smallest companies in the stock market, the smallest decile, the smallest 1%, because those are still multi-hundred million dollar companies. After we adjust for size, we then have to look at industry, which is medical industry and the greater risk associated there, and specialty. So different specialties can have different risk rates applied. Then we add for that particular practice, what's a risk rate for that particular company. You know, there's less risk in a larger group because there's other associates that can step in the loss of one physician versus a solo practice where the physician is gone. Under corporate practice rules, there's nobody to run the practice, and the practice might have to be liquidated. That's a higher risk. The result is coming up with the risk return on investment needed, or what we call a capitalization rate. So to summarize the methodology of the income approach, we normalize the income, we subtract from that the market rate compensation as if the owner was employed, including like full-time equivalents. Times that, we say, what's the growth rate going to be, you know, without the buyer doing anything. It's going to grow anyway. Generally, right now, we've been looking at 2% growth rates. And then divide by the cap rate, that risk rate, what's the return on investment, which equals the fair market value. Each of these steps is quite complex, and there's plenty of opportunity for error. In the asset value, if we don't find dividends under the income approach, and we don't find that a particular small practice usually is represented by the market approach, or often practices that don't have goodwill value are not reported to the goodwill comparison databases, then we're probably looking at asset value as the highest and best. So for example, if a practice has $1 million worth of eBay value assets, but it's been a Medicaid practice in a bad neighborhood where the economy's gone down, the Rust Belt or post-tornado or something like that, then we're going to look at the asset value. If it's a going concern, we use fair market value, the tangible assets, without a cost of liquidation. If we have to liquidate and actually sell it on eBay or through an auctioneer, there's going to be some costs associated that we subtract to come up with the liquidated value. Usually, all three approaches are going to find different results. When you run the asset, income, and market approach on a particular subject practice, almost never is the number the same between the three. So then we have to figure out which one's best and pick one, or we weigh them. And that's where the logic, reason, experience of the particular appraiser has most impact. So when we reconcile, Again, the IRS says the income approach should have the uh, most weight absent good argument. Otherwise, we apply a weighing. Now, when we do weighing, we don't ever weigh the asset approach versus market income. Like we don't say a third, a third, a third, because the asset approach must be prevail or be excluded. So if there are dividends, if we find value in the income or market approach above the asset value, then we toss out the asset value and have to make a decision between income and market. So in this example, we put a 60% weight on income and a 40% weight on market to come up with our final value of $360,000 rounded. Now there's lots of errors that can be made in doing appraisal. The first is the failure to normalize income properly. So for example, I have seen examples as an appraiser where the owner has a giant motor home that he uses as housing sometimes at CME meetings, but is not a normal asset that's going to be used. The cost of that motorhome is not normally going to be in a medical practice, and the buyer isn't going to use it. So we have to normalize it out. More commonly, though, what we normalize out is the owner's retirement contributions. If you don't bring that back into the income stream, you're going to undervalue the practice. Using incorrect market compensation and full-time equivalents is a big error. So if you take a family physician who can get lots of job choices at $200,000 a year, and if you undervalue the compensation at 100, it's going to leave more dividends and inflate the value of the practice. If you say the fair market value is 300,000, it's going to overvalue the compensation and undervalue the practice. And that you have to go to the databases. It's not necessarily the compensation of the owner with a managed or mismanaged practice. We have to look at the market value. What are they going to go if they take a job, for example, at Kaiser? Now, the full-time equivalents, we're generally looking at 36 clinical billable hours a week. So if someone is working 75 billable hours a week and the income of the practice is double what a normal physician would make, it might still be just limited to compensation for labor. There might still be no dividends. Versus in another case where you have an absentee owner that has employed physicians working there, all of that owner's income is going to be dividends, and we don't apply another subtraction for fair market value of labor. Many errors are made in that particular segment. I see appraisals that don't consider issues like Medicare or Obamacare on the value of practice. They don't consider new technologies and science that are affecting particular practices. And that really gets down to the specialty level. When Medicare, for example, reduces reimbursement for multiple surgeries or for assistant surgeons, that is going to have an effect on profit, dividends, and therefore value. I tend to think that reimbursement is going to continue to trend downward, but in a particular situation, we might find the reverse. It doesn't happen very often. One error that's sometimes made is using after-tax versus pre-tax income. And there's some debate there about which is most appropriate. Big C corporation practices, sure, should use after-tax income, but your small practices, your sole proprietorships, your S corporations, your LLCs, usually are what we call pass-through entities, where the income passes through to the owner and is taxed at their personal income level without first applying a large corporate level tax. I think that's more appropriate for small practices. The cap rate is one of the most common errors I see, where uninformed general appraisers don't understand all the risks of Obamacare and accountable care organizations. They don't know about already stipulated Medicare cuts that are currently part of law. Whether or not they get reversed, it's the current law. And so if you underestimate the risk, it results in too much value. Another error is not comparing apples to apples. If you just take, for example, the Goodwill Registry reports as a whole, embedded within there, there are things like results of divorce cases wherein it wasn't really a sale. It's not a market comparison. It's not fair market value. Maybe the judge just wanted to dust that case off his desk as fast as possible, so he just split the difference. Judges often make errors. That's why we have appeals courts and Supreme Courts. Now, in the case of a buy-in or a minority shareholder purchase or payout on a seller, there's an issue what's called discount for lack of control, which is very important. If you have less than a 50% ownership, either the other person or group of persons has 100% of control, and they can do with the company whatever they want, maybe even sell the company without your agreement. So that increases risk and should result in further discount to be applied. And there are a series of considerations. There's whole books written just about discount for lack of control and how that should be applied, but there's reasonable ranges that ought to be able to be applied beyond the scope of this presentation. Now, how do you find a good appraiser? Well, first, they ought to be a member of a legitimate appraisal association, like IBA, NACFA, or the American Society of Appraisers. And they should follow industry standards from USPAP, what is the Uniform Standards of Professional Appraisal Practice. It's the scientific methodology that's been accepted by the IRS, most states, and most organizations. It's also helpful if they are a specialist in medical practice. Veterinary practices and dental practices, because they're not affected by things like Medicare or government intervention, tend to have higher valuation ratios than do medical. So somebody that only does dental and doesn't do the full background investigation on medical is going to overpraise a medical practice. You can tell the difference between a legitimate and an illegitimate credential by going to the association website and looking at it. It's pretty simple. There are some credential mills out there that crank out credentials for appraisers that no one's ever heard of except people that pay the $50 for that particular credential. So because appraisal is not a licensed business appraisal, is not a licensed activity in most states like real estate appraisal is, you have to do some extra due diligence in determining who you're hiring. Most healthcare appraisers specialize because it's so difficult. Most general appraisers might do one or two healthcare appraisals and then back off because their report was heavily critiqued by the other party's appraiser. You have to expect that the other party to the transaction is going to have an expert on their side. And so you really want to start with a good quality appraisal that any other expert is going to review and go, yeah, this is a good quality appraisal. My opinion's not that different. There's different levels of appraisal when you go to get one. Low, medium, high is an easy way to describe it. The highest level is what we usually use for courts, for litigation. The lowest level can give you a pretty good estimate of value, but it doesn't give a full explanation of how the appraiser got there. Usually what we use is the middle level of appraisal, what's called a USPAP compliant, IRS compliant appraisal that meets the standards. Everything is narrated. A lay person can read the whole appraisal and understand how the appraiser got there. There's no voodoo involved. You should be able to, if you disagree with an assumption, like if you think Medicare reimbursement is going to go up instead of down, you can modify that yourself and work through the formula and determine what the impact is going to be. So most often you're going to be looking at a middle level appraisal. If you need, in addition, a practice broker, use a licensed broker, even just for advice. The states that require There's more states that require a broker license than require an appraiser to be licensed. For example, Florida is probably the biggest example that requires an appraiser to have a Florida state license, which most appraisers don't. I do, but most appraisers don't. Also, I'm licensed in California. More states require a practice broker license, and if they do, use a licensed broker. Even if you're just getting advice, use somebody that knows the difference between a general practice and a general surgeon at the most basic level. So in summary, what's a practice worth? Well, it all depends on a whole series of circumstances and facts that often takes quite a bit of work to do. For myself, even the most basic practice is usually going to take me between 15 and 20 hours to plow through all of the accounting, all of the adjustments, all of the deductions that were taken. We have to look at the specialties, see what's happened. The day before Obamacare passed and the day after Obamacare passed are going to be different. So those appraisals are going to differ. Again, I'm Keith Fulgham. I'm a certified healthcare business consultant. I'm a licensed practice broker and licensed appraiser. I've been on faculty teaching courses for many of the national medical associations and societies, which you can see on my CV at my website, which is medicalpracticeappraisal.com. In summary, you wouldn't go to or refer a patient to an unlicensed so-called doctor. So don't use unlicensed, uncertified consultants acting as an appraiser or broker. Thank you.